Inflation, a term frequently heard in economic discussions, refers to the rate at which the general level of prices for goods and services is rising, and consequently, the purchasing power of currency is falling. While a moderate level of inflation is often seen as a sign of a healthy economy, high or runaway inflation can erode savings, reduce consumer confidence, and destabilize financial markets. This is where monetary policy, primarily executed by central banks, comes into play. Central banks, such as the Federal Reserve in the United States or the European Central Bank, are tasked with maintaining price stability. They use a range of tools to influence the money supply, credit conditions, and interest rates, which in turn affect inflation. One of the primary tools is adjusting the policy interest rate, often known as the federal funds rate in the US or the main refinancing operations rate in the Eurozone. When inflation is high, central banks typically raise this rate. This makes borrowing more expensive for commercial banks, which then pass on these higher costs to consumers and businesses through increased loan rates. Higher borrowing costs discourage spending and investment, slowing down economic activity and reducing the demand that often fuels inflationary pressures. Conversely, if inflation is too low or the economy is sluggish, central banks might lower interest rates to encourage borrowing, spending, and investment, thereby stimulating economic growth. Another tool is open market operations, where central banks buy or sell government securities in the open market. When a central bank buys securities, it injects money into the banking system, increasing the money supply and encouraging lending. Conversely, selling securities removes money from circulation, reducing the money supply and tightening credit. Reserve requirements, the fraction of deposits that banks must hold in reserve rather than lend out, are also a tool. Lowering reserve requirements frees up more money for banks to lend, increasing the money supply, while raising them reduces available funds. Finally, quantitative easing and tightening are less conventional tools. Quantitative easing involves large-scale asset purchases to inject liquidity into the economy, especially during crises. Quantitative tightening, the reverse, aims to reduce the money supply by selling off those assets. In summary, central banks play a crucial role in controlling inflation through various monetary policy tools. By skillfully managing interest rates, open market operations, reserve requirements, and quantitative measures, they strive to maintain price stability, foster sustainable economic growth, and protect the purchasing power of currency.